It seems unlikely that the labor market will be a source of elevated inflationary pressures anytime soon. We do not seek or welcome further cooling in labor market conditions. Overall, the economy continues to grow at a solid pace, but the inflation and labor market data show an evolving situation. The upside risks to inflation have diminished, and the downside risks to employment have increased. As we highlighted in our last FOMC statement, we are attentive to the risks to both sides of our dual mandate. The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks.
Coming up today, stocks rally after J-Pow says rate cuts are coming. Just how big is he going to cut next month? Vanguard says the stock market is overvalued. Bank of Japan warns markets are unstable. Global markets react to J-Pow. An inside look into the gold market. And a Kansas bank CEO just got sent to jail for 24 years. It's a big one today, guys. Let's go. And there we have it, guys. We didn't get the classic rug pull. In fact, it was quite a bullish day out there. With J-Pow coming in as expected and pretty much telling the market directly he's going to start cutting rates next month. And stick with me because I'll dive into that soon. Just looking at the S&P 500. Now within a stone's throw of all-time highs, 40 points away, with the market color looking very bullish across the board. However, just looking on my main technical chart here, did just get the third reversal signal fire off today. Last time we got that back in the middle of July. Time to top pretty well, and we do have a bit of a bearish divergence on the DSI as well. However, just keep in mind in technical analysis, especially when charting stock indices or stocks, bearish signals hold much less strength than bullish signals do. In other words, they're not as accurate. We can see that with my reversal signals back in June. And that's because one of the most bullish things stock indices and stocks can do is get technically overbought and stay there for an extended period of time. Markets can just grind higher on really low volatility. And so we're at a bit of a technical crossroads in the stock market. This double top bearish divergence could play out. However, we are getting a lot of other technically bullish signs out there, which I'll show you later on in this video as well. For example, why the Russell 2000 small cap ETF ripped up over 3% today. I'll show you the reasons why I think that's happened, and it's not to do with J-Pow either, because the same thing I'm talking about is also helping to get Bitcoin ripping today over 6%, along with regional banks up over 5% as well. And we'll come back to the charts later on, and I'll show you everything else that's moving out there to help give you the overall picture of financial markets so you can make better decisions. First, let's just talk a bit about what J-Pow said today in this really highly anticipated speech from Jackson Hole. The big takeaway is, he said, and I quote, "The time has come for policy to adjust." And just looking in Barron's at some key points of J-Pow's speech this morning, he's really talking about the jobs market a lot. I got the impression listening to him, he's starting to worry a bit about the jobs market. That last jobs report, first Friday of this month, where unemployment jumped to 4.3%, may have sent a shiver down his spine, and he's worried about this getting away from him, and so he wants to get out in front of a potential recession. And we heard that with him saying, like I'd been saying recently, the risks have moved from the upside in inflation to the downside in the economy, pointing out the labor market is cooled enough. He doesn't want to see any more cooling. That's not his mandate. He's confident inflation's heading back down to the Fed's 2% goal. Seems pretty chuffed with himself, to be honest. Almost like he declared mission accomplished on inflation. Said the soft landing for the economy is in play, and bottom line, he's about to start cutting interest rates in the United States and start embarking on an easing cycle following his global counterpart. And I'd say you'd be a little bit nervous of what the next unemployment rate's going to print at first Friday of September. When we get a look at the August jobs data. Kind of left the door open that he could start off big with 50 basis point cut. Could have helped the stock market get excited a little bit today. Also pulling back bond yields a little bit as well, with more weakness in the US dollar, firming the price of gold and a few other commodities today as well. I'll show you on the charts a bit later on. So that is going to be a big print on the first Friday next month. Jobs report, unemployment rate. That comes in at 4.5. He may just go ahead with a 50 basis point cut. However, according to Goldman Sachs, they expect the August employment report will be stronger than the July report, and that the Fed will cut by 25 basis points next September. But I think 50 basis point cut would be likely if the unemployment report is soft again. And that's pretty much exactly what I think as well. And there's a look at the Fed Fund Futures pricing of interest rates going out in the future. Give a bit more weight today to a 50 basis point cut, but still about 2/3 of a 25 basis point cut. And I'm going to continue to put my odds of a 25 basis point cut at 70%. However, after today, just confirmed what I thought. I'm going to give no chance to them staying on hold, and I'd give it about a 30% chance. The unemployment rate could tick up, and that would induce Jay to start off really strong with 50 basis points and get things underway. However, that could make him sweat as well, because cutting 50 basis points could really ignite animal spirits in risk-on markets as well. And that wealth effect can play through to the real economy. Most wealthy people have a large part of their wealth in the stock market, and when their portfolio is doing well, they're much more likely to make discretionary purchases, and it's kind of a halo effect from there. So even though inflation's definitely been coming down, and it appears everything's good for now, don't be fooled, inflation could still very well come back. Even if the government does impose price controls on your local grocery store, inflation's much more structural and deeper than that, with the biggest part of it being the supply of money. Think about the total amount of goods and services versus the total amount of currency. The more currency you have, naturally the higher all prices are going to be. And so you can thank your government for being responsible for about 80-90% of inflation. And here's a look at a 100-year chart of the year-over-year change of inflation in the United States. And what's one thing you notice about this chart that's kind of different to a lot of other financial markets? Well, one thing that sticks out to me about the structure of this chart straight away, and what's different to a lot of financial markets, is you see kind of persistent trends in the stock market and commodities, up and down, whereas this one's very spiky. Spikes up, spikes down, and it comes in waves. It's not just this nice long downtrend, then uptrend. It's up, down, just like we saw in the 1970s. Fed was cutting rates in the mid-70s as well, as inflation was coming down, caused a second and larger wave. And sure, there's always differences each time, even though there's similarity. Geopolitics, very similar now to back then. However, the US was much more dependent on the Middle East for oil back then compared to now. However, what's different now is quantitative easing. We didn't have a Federal Reserve create $9 trillion out of thin air and pump it into markets back then either. Nor did we have interest rates at rock bottom for 15 years. And so wouldn't it surprise a lot of people if we did another spike up, and who knows, maybe even higher in the coming years? Because the fact is, no one knows for sure what inflation's going to do. In a year or two from now, J-Pow's not even sure what the jobs report's going to come in 2 weeks from now. And I'd say if this doesn't happen, that would be the unusual thing. A lot of people, markets, J-Pow honestly thinking that inflation is just going to do like this for the rest of the decade. That would be a true Goldilocks period. But I'd say it's almost impossible, given the supply of US dollars out there. And the likelihood the next hiccup we get in markets or the economy, they're just going to do the same thing again. It's just hard to see inflation for the United States dollar getting below 2% or 1%. We'd have to see a really deep, dark recession to get that deflation, although that would be short-lived, because I'd say they'd just flood the heck out of markets if that happened anyway. And so if that potential resurgence in inflation over the coming years, thanks to looser monetary policy, does emerge, then what can us as investors do to at least hedge against that? Well, I've said it a million times, I'll say it once more. Gold. Just looking back at the price of gold in the 1970s, had a huge bull market for that first wave of inflation, pulled back going into the mid-70s, and just like inflation, it just shot up to a brand new all-time high, going from $100 an ounce to almost $900 an ounce in about 4 years. And here we are looking at gold today. It's already on the march higher, and it's done pretty well in the last 4 years. And I'd say that's got a lot to do with the explosion in the supply of new US dollars, for which gold primarily priced in. So just getting back to the data, looking at the market's pricing of US interest rates going out in the future, pricing a terminal rate about 3% to be hit by about Christmas next year. Pretty aggressive, and you could say consistent with an expectation of a recession occurring in that time as well. Not a big, deep, dark one that could take rates below 2%. Good news is the Fed does have a lot of ammo to work with if we do get a recession, being 500 basis points above zero. But I'd agree with Mohammed Al-Iran. I think the market's pricing in too many cuts, pretty much ignoring all risk of a resurgence in inflation. And I guess this has been a pretty good outcome for the economy, markets, and J-Pow. Now we've got unemployment turning up. It could have been worse. It could have started turning up when inflation was still tracking at 4%. And there was the risk of that stagflation scenario emerging. And so Fed Fund futures and the bond market are either convinced inflation's going to rock bottom, or there's going to be a sharp contraction in the economy to justify a pretty swift rate cutting cycle. However, what about retailers? What are we hearing from them? Well, the message is quite mixed. A lot of companies that have cut prices, like Walmart, Target, TJX, they're reporting strong quarters, indicating stability with the consumer. We're seeing others saying a lot of consumers are pulling back on their discretionary spend, becoming a bit more careful with what they buy, not really doing a whole lot of home improvement. But it again depends what company you listen to. We just got earnings today from Hot New Restaurant Group, listed on the stock market, Carver Group, reporting their net sales jumped 35% year over year and raising their full year outlook to sales growth up to 9.5%, and this was a bit of a turnaround from a softer Q1 they had. They're seeing higher foot traffic, people coming in to get a juicy steak, and of course, this is more the top end of the consumer. Now, like I said, if the stock market's still rocking, they're still happy to be out there doing plenty of discretionary spending, and the market will reward the companies that benefit from that. We can see that with Carver Group, up a huge 19.6% today on big volume, breaking out to highs, having a really good year, which again is not normally a thing you would see in a bear market. A real discretionary stock acting like this. And so you probably saw the Russell 2000 rip up over 3% today, while mega cap tech wasn't that real excited, just up barely 1%. And it's normally the big tech growth stocks that respond to the prospect of lower rates. And even though we did get a bit of a bump up in the semis, 2.4%, that was nothing compared to home builders, up 4.2%, and regional banks, up a whopping 5% on big volume. Really big solid move there on the charts. And so no doubt, a dovish J-Pow definitely helped small caps, Bitcoin, and regional banks rip up today. However, what I think really helped it is this guy here, Robert Kennedy Jr., pulling out of the presidential race and endorsing Donald Trump, which I think's got financial markets increasing their odds of a Trump victory. And that's why we've seen the Trump trade coming back on, with small caps, Bitcoin, and banks said to be the biggest beneficiaries of a Trump White House, which favors more domestic company. And so RFK could be bridging the gap by a lot of people caught in the center of this election and helping them switch over to the red side. And that certainly appears to be the price action in markets today, as Trump and Vance are more pro crypto and Bitcoin than Kamala Harris. Really strong move there in Bitcoin. And we can just see in the spread of small caps versus large caps, which shot up really big after the assassination attempt on Trump. Then a bit over a week later, Biden pulled out, and then Kamala Harris, which has been real amazing to watch. As last time she was running for president, she was polling at 4%. She had to pull out of the race. Apparently now she's 54%. And with that increase in her odds of winning the election, the huge rotation into small caps, the Trump trade, had been getting unwound this last couple of weeks. However, as you can see on the chart here today, we got a big bump up, and I think that's due to RFK's endorsement of Trump, likely increasing his chances of winning. However, at the same time, we've seen Kamala Harris's popularity grow in the polls. We've seen the US dollar come on off hard as the market's getting worried about potential socialist policies, overspending, overtaxation, leading to a devaluation in the US dollar, flight of capital from US markets from foreign investors, amongst other things. And that's not my political opinion. That's simply the price action in financial markets, and as has been widely reported from a lot of Wall Street research houses as well. But just as a side note, if you do want my opinion on anything, kind of refreshing to hear a politician like RFK talk about improving people's health, talk about improving diet, getting rid of seed oils, getting rid of highly processed foods, really taking a stand against big food, big pharma, the industrial military complex, censorship. I'm sure a lot of people agree with a lot of what this guy says. I believe his heart's in the right place. And so he could have a real material effect on this election and kind of be the swing factor in it all, as he does have quite a large following. And if he's directing people to vote for Trump, he very well just may help him get across the finish line. And all that does have an effect on financial markets and us as investors. Who is leading the US economy for the next 4 years? And so he's got guts, I'll give him that, to stand up to all these state-run agencies and call for a complete overhaul of the system. Because it's true, most causes of death in the United States is diet related. And so at the very least, it should be looked at, because America does have much lower standards when it comes to food quality and what can be added into food compared to other Western countries. And a lot of data and science attributes that to the big divergence of the life expectancy in the United States versus the health expenditure per person when you compare that to other countries. Down the bottom is the spending, from 0 to 10,000 per person per year on health. On the left is life expectancy. So basically America spends way more per person on health and lives a lot less compared to these other developed countries. And a big part of that is the huge cost of healthcare in America. A lot of people don't seek it because of it. But also a big difference between America and other countries is the quality of food. Generally speaking, that is. It's not in every city, not in every instance, but just looking at the broad view of the data, RFK's right. There is room for improvement, and it should be looked at for everyone's benefit. Anyway, I digress. Getting back to the stock market, interesting to hear Vanguard, normally really conservative, doesn't really like to make big calls, and their business pretty much runs on accumulating assets, keeping people invested in the stock market. They actually came out today and said US stocks are overvalued because of unrealistic expectations for AI-powered economic growth. They said firms would need to grow profit by 40% annually for the next 3 years to match valuation. That's double the annualized rate of the 1920s, when electricity lit up the nation. And it's true, looking at long-term stock market valuations in the United States, they are pretty lofty, got some pretty high expectations of growth in the future that, if are not met, could trigger a decade of underperformance. We've also got BCA research coming out and said a recession is coming in the US, and even rate cuts now cannot prevent it. They said every single one of us now believes there's a recession, and that's exactly the opposite of what the market believes. Pointing to a deteriorating US labor market, US manufacturing falling to an 8-month low, and that things are breaking down quite rapidly now. And it's true, there is definitely a few signs of softness out there developing in the economy, and just like the inverted bond yield curve Another thing that's hard to escape from is the fact a lot of the time when the Fed cuts rates, here in the black line, the stock market can quite often go into a drawdown. That was especially the case 2008 going into 09 and in the early 2000s. Did get a bit of a rate cutting cycle starting in 2019 and COVID, but that drawdown in the market pretty much just lasted a month. Then prior to the 2000s, we did get a little bit of cutting in the mid-90s, didn't really get a drawdown. We did get a big easing cycle in the early 90s, did have a short, sharp-lived recession and drawdown in the stock market, but it held up pretty good considering all that. And so it's not unreasonable to expect a drawdown in the stock market that accompanies a Fed easing cycle. And it's not really a good sign either when you've got the world's arguably third most important central bank and their governor warning that markets are unstable. And he's not just talking about his local market either, he's talking about global market. We are in the midst of a transition in central bank policy that can bring about some volatility 2 months out from what could be a hotly contested US federal election. Geopolitics still elevated, valuations questionable, and the fact now we've got the Fed starting monetary policy easing while the Bank of Japan's also signaled more potential monetary policy tightening, increasing their rates. We may not have seen the end of the yen carry trade unwind. We most certainly could have another episode or two, similar to what we saw earlier this month on the 5th, Black Monday in Japan. It spilled over to the rest of the world, and that's because the gap between the interest rates in the States and Japan is narrowing, and that could cause more of these leveraged yen carry trades to be unwound. And so like I've been saying, the bond market has really been forecasting this, almost throwing a tantrum and demanding J-Pow start cutting rates. However, yields dropped a little bit more today. See that in the 2-year, down to 392 at the bottom end of this range it's been in the last 2 weeks, and the 10-year as well at 380. And I'd say that's the market giving some possibility that J-Pow could cut 50 basis points, and I'd say the bond market's still nervous about the US economy. However, along with the stock market, we've just got a big divergence in high yield bonds. They're not nervous about the economy at all, actually breaking out to 52-week highs today, with high yield credit spreads really tame, 3.21 on top of treasury. So markets are basically expecting the economy to contract, just not a real deep dark recession, but almost a soft landing or no landing. And even though the US dollar is weak at the moment and is worried about what future government policy has in store for it, the fact is the US dollar reserve's not going anywhere anytime fast. It's still used in the vast majority of global transactions. And the fact is, and I can testify for this as well, as I've been fortunate enough to travel around the world, Americans just work a lot harder than most other Western developed countries. We can see that in productivity. Over the last 20 years, it's exploded more than the Eurozone and United Kingdom. And so one of the big ways how they work out productivity is the GDP of the economy divided by the amount of labor hours worked. And so America's obviously technologically out up front, but also Americans work a lot harder than their counterparts in Europe. A lot of Americans will be lucky to get a day off for their birthday, week or two a year, many of them unpaid. However, it's not unusual in Europe to get someone's out of office reply, they've gone on summer vacation for 6 weeks. They'll get back to you then. But my point is, a country's productivity correlates with the strength of their currency, as it keeps their output strong, keeps foreign capital coming in, and this is just another reason why the United States dollar will be the preferred currency for many, many years. It's just under threat at the moment. And just moving on to commodity markets and the reactions we're getting out of them after Jackson Hole this morning. Oil getting a nice bounce off its support zone, as this could help demand for oil, taking the pressure off consumers with interest rates, giving a bit more cash. And we also got news. The Biden administration had been buying the dip, replenishing the strategic petroleum reserve as promised. And that's just another one of the big reasons keeping crude oil kind of a gridlock sideways pattern. Starts getting to the low 70s. Government can start refilling SPR. There's still a lot of geopolitical risk out there. Starts getting too high, they'll threaten to release from the SPR. And the fact is, the world's awash with supply, and there is demand worries as well. So it's hard to see it going above 86 anytime soon. We'd have to get a real material supply shock out of the Middle East for that. Which, even though we're not getting the headlines of late, it appears Iran may have backed down. However, we don't know that for sure. United States continuing to build up a military presence in the Middle East, one of the largest we've ever seen in our lifetimes. So they're ready for a full-on regional war in the Middle East, and there's still the tail risk of that happening, which could also be helping keeping the price of gold firm. In addition to a dovish J-Pow, that's a tailwind for the price of gold as well. Since it competes for investors' capital, there's less yield on bonds, gold looks more appealing because it's a non-yielding asset, and Bank of America is bullish on the shiny metal, saying investors should keep buying it, as they're worried as well. Fed rate cuts could bring back inflation, which is bullish for gold. It's definitely got some momentum. Investors are coming back to it. We still haven't broken out to inflation-adjusted highs from 1980. Non-Western central banks can't get enough of it either. Poland, using their recent economic strength to further buy up a lot of gold. They're aiming for it to be 20% of their bank's reserves. And we can see that in this chart here. Of the 10 years up until late last year, there's been a huge amount of net buying in gold. Russia's added over 1,200 tons, China 1,100, Turkey 400, Poland, India, and other BRICS nations really moving away from the US dollar. And it's not just those foreign central banks. A lot of people have worries about the world. Like I said, you can think of gold as insurance on your wealth, especially if you've got a lot of it denominated in the US dollar. The fact is, it's been a store of wealth for humans for 6,000 years, has many of actual practical uses, and doesn't rely on a digital communications network. And that's the main difference between gold and Bitcoin. Bitcoin also has its advantages that gold doesn't have. That's why a lot of investors have both. It's a good way to diversify out of fiat currency, at least as a hedge or insurance policy. Because even with how much real estate's gone up in these last couple of years, pretty much 100 years ago, 10 kilos of gold equaled the same amount as an average house price, just like it does today. In other words, even though house prices have gone up a lot, inflation adjusted, that's thanks to the huge increase in supply of US dollars. Gold hedges out that risk because it's priced in US dollars. So it's insurance against inflation and the debasement of your local currency as well. And they're not just gobbling up gold, they're also gobbling up silver. We've seen that with China. The world's still discovering what can be used with gold and silver. We just saw yesterday Samsung developing a new silver battery for EV with a lot better specs compared to others. And just like AI, there could be a global race for who can accumulate the most precious metal. And just getting back to crypto always keeps it interesting and entertaining, doesn't it? Quite often getting these headlines. A crypto scam sank a Kansas bank and got its CEO sent to jail for 24 years. CEO was caught in a pig butchering scam. And for those of you who don't know what a pig butchering scam is, it's a classic one as old as the hills, named after the method of farmers fattening pigs up before being slaughtered. Criminals develop a relationship with victims and convince them to keep sending money, promising lucrative returns from investments, only to disappear with the funds later on. So it's a common scam you'll see. Someone will reach out to you and they'll offer you something that pretty much always sounds too good to be true, like guaranteed returns. They'll ask you to send a little bit, they'll send you a little bit more back. They develop a relationship and convince you that they've found some sort of magic potion, and then they go big. Then they say, okay, send me 10,000, 20,000, 50,000, whatever it is, and then off they go. And so it's kind of unbelievable. A CEO of a bank fell victim to this, and him stealing 47 million from his bank to put in what he thought to be a legitimate crypto investments. Now he's got quarter century in the slammer. And I guess this is what just makes these Bitcoin ETFs so appealing, because a lot of the crypto world is so muddy, murky, unregulated, offshore, full of crooks, criminals, everything in between. And so if you can buy an ETF with BlackRock as your custodian, it's the safest way for many investors, small and large, institutional money, for them to play Bitcoin at the BlackRock Bitcoin Trust IBIT. Now with 21.5 billion assets under management, actually got a good bit of volume in there today as well. And just looking out to the next week, kind of the tail end of Q2 earnings season, still a few retailers to come in. Chewy, Foot Locker, Abercrombie & Fitch, Dollar General, Best Buy, and a few others. But the big one, Nvidia, Wednesday after close. That's the biggest event next week. And I'd say the expectation is for them to beat on EPS estimates. Market will be really looking for rosy guidance. We don't want to hear any signs of their customers pulling back on purchases or planning to pull back on purchases. That could develop a worrying narrative of mega cap tech starting to dial down their AI capex spend. However, Jensen Huang is pretty good at developing excitement, getting the hype train going, even though he has been selling a lot of stock in this period here. In fact, over $800 million worth. This will be a real test for the market. Can Nvidia break out to new all-time highs, help to take semis and the Nasdaq with it? Or is it going to disappoint and we're going to get a big gap down and the narrative and feel of the market's really changed? Because like I said, just looking at the semiconductor ETFs, definitely lost momentum this last few months, is consolidating and could be potentially developing like a head and shoulders type formation. It's not able to clean take out these highs. So we could get a real look at that with Nvidia's earnings next Wednesday. Just looking at the economic calendar next week, starting things off with durable goods. First up Monday, consumer confidence Tuesday. Wednesday, not much. Thursday, we get a look at the GDP growth rate for Q2. How much did the United States economy grow in the second quarter? Consensus is it did at an annualized rate of 2.8%. That'll be the biggest economic data print we get next week. Going into Friday, get a bit of inflation data out from the Eurozone. They expected to come in year over year 2.3%. And then we get some PCE inflation data from the States. Headline expected to come in 2.5%, core 2.6% year over year, along with consumer sentiment. So that'll be pretty important one as well to finish the week out. GDP, PCE, and Nvidia earning. Top 3 events for next week. And that's pretty much a wrap for the daily market review this week, guys. And there we are on the weekly chart of the SPY. A little bit of a bearish divergence along with those reversal signals on the daily. However, like I said, they carry a lot less weight than bullish signals. Market's kind of at a testing point here, at least technically, going back to the daily chart, pressing up against all-time highs. With Nvidia's earnings and GDP data, then the real big one will be in 2 Fridays' time, jobs report. That's what the market's really going to be looking at. To whether J-Pow starts cutting by 25 basis points or 50 basis points. As it's all but certain that he is definitely going to start easing, pretty much told us that directly today. And like I said, in my opinion, he's worried about the jobs market getting away from him. Thinks inflation's all good for now, and the stock market and high yield bonds is liking that narrative, even though the US government 10-year bond yield still could be pricing in a recession around the corner as well. Either way, as always, we'll follow the tape and I'll keep breaking it down for you every day. Thanks very much for sticking with Click Capital. Have a great weekend, and I'll see you Monday night. Cheers.